Welcome back to Muscular Brain, Fat Wallet. Today, we'll discuss how to invest in real estate with little to no money. Real estate is one of the most reliable ways to build wealth, offering consistent cash flow, appreciation, tax benefits, and the power to leverage other people's money. Many successful investors started with minimal capital, using creative strategies, and today, we'll explore these methods in detail. In this video, we'll cover leverage OPM, other people's money, wholesaling real estate, seller financing, lease options, rent-to-own, house hacking, real estate partnerships, crowdfunding, subject to financing, BRRRR strategy, buy, rehab, rent, refinance, repeat, creative financing methods. By the end, you'll have a toolkit of strategies to jump into real estate with minimal upfront capital. Let's start with OPM. Leverage OPM, other people's money. What is OPM? OPM is all about using other people's money to finance your deals. Private money lenders, individuals who lend money informally, and hard money lenders, professional companies with higher interest rates, are both forms of OPM. How to use OPM: for example, say you find a property worth $200,000, and it will be worth $300,000 after repairs. You convince a private lender to fund the purchase and repairs in exchange for a portion of the profits. By using OPM, you can control properties without using your own capital. Finding lenders: to find OPM, attend real estate networking events and connect with potential lenders. Your pitch should focus on the property's value, projected return on investment, and a clear exit strategy. Wholesaling real estate. What is wholesaling? Wholesaling is a great way to invest in real estate with no upfront money. You don't buy the property. Instead, you get a property under contract and assign the contract to a buyer for a fee. How wholesaling works: you find a distressed property with a motivated seller. Once you have the property under contract, you sell the rights to that contract to another buyer for a profit. If you have a property under contract for $80,000 and sell it to a buyer for $90,000, you pocket the $10,000 difference. Building a buyer's list. Success in wholesaling depends on having a solid buyer's list. Attend real estate events and join online investor groups to build relationships with investors who are ready to buy. Seller financing. What is seller financing? With seller financing, the seller acts as the bank, allowing you to make payments over time instead of getting a traditional mortgage. This method works well if you can't qualify for a loan or don't have a down payment. How it works: you negotiate with the seller to make payments over a specified period. In many cases, this allows you to acquire a property without needing to go through traditional financing methods. Sellers may prefer this arrangement if they're looking for steady income or have tax concerns. Real-life example: let's say a seller agrees to finance a $250,000 property, allowing you to make a down payment of $10,000 and finance the rest at a 5% interest rate over 15 years. This gets you into the property without needing to go to the bank. Lease options, rent-to-own. What is a lease option? A lease option allows you to lease a property with the option to buy it at a future date. This is a great way to control real estate without buying it up front. How lease options work: you make two agreements, one for leasing the property, and the second gives you the option to purchase the property later. A portion of your rent is often credited toward the eventual down payment. Benefits of lease options: lease options allow you to lock in a property at today's prices while you save for a down payment. You can also sublet the property for more than your monthly payment, generating cash flow while you wait to buy. Real-life example: imagine leasing a property for $1,500 per month, with $300 credited toward your eventual purchase. If property values rise, you're locked into a lower price and have built equity with your rent credits. House hacking. What is house hacking? House hacking is living in a property while renting out part of it to cover your mortgage. This strategy is commonly used with duplexes or triplexes, but you can also rent out rooms in a single-family home. How it works: let's say you buy a duplex for $300,000 using an FHA loan with a 3.5% down payment. You live in one unit and rent out the other for $1,200 per month, covering your mortgage and living expenses. Why house hacking works: house hacking reduces or eliminates your housing costs while helping you build equity. FHA loans allow you to buy with as little as 3.5% down, making it accessible to first-time investors. Real-life example: Sarah buys a triplex for $400,000, rents 2 units for $1,500 each, and covers her mortgage. She lives for free and even generates positive cash flow each month. Over time, she refinances to pull out equity for future investments. Real estate partnerships. What are real estate partnerships? In a real estate partnership, one partner provides the capital, and the other handles the deal's operations. This is a great way to invest with no money if you can find a partner willing to fund the project. How partnerships work: for example, you find a $150,000 fixer-upper, but you don't have the money to buy it. A partner provides the funds, and you handle renovations and management. When you sell the property for $250,000, you both share the profits. Finding partners: network with potential partners at real estate investment clubs or online groups. You can also pitch to friends, family, or colleagues who want to invest but don't have the time to manage properties. Real-life example: Mike has experience with renovations but lacks funds. John has money but no time to manage a property. They partner up, split the profits, and both come out ahead. Real estate crowdfunding. What is real estate crowdfunding? Crowdfunding platforms allow investors to pool small amounts of money to invest in larger real estate deals. This option provides an easy way to invest with little capital, while still taking advantage of large deals. How crowdfunding works: online platforms like Fundrise or Realty Mogul allow you to invest as little as $500 into large real estate projects. You earn a share of the profits without having to manage the property yourself. Advantages of crowdfunding: crowdfunding offers diversification because you can invest in multiple properties with low upfront costs. It's also passive, as you don't need to manage the property or tenants. Real-life example: you invest $1,000 in a real estate fund that owns multiple commercial properties. Over time, you earn dividends from the rental income and appreciation without lifting a finger. Subject to financing. What is subject to financing? In a subject to financing deal, you take over the seller's existing mortgage, making payments on their behalf. This method allows you to acquire property with little to no money down. How subject to works: you negotiate with the seller to take over their mortgage. The property stays in their name until you pay it off or sell it, but you control the property and the income it generates. Why sellers agree to subject to deal: sellers who are struggling to make mortgage payments may agree to this arrangement to avoid foreclosure. For you, it's a way to acquire a property without needing traditional financing. Real-life example: you take over a mortgage with $200,000 left on it and agree to make the $1,200 monthly payments. You rent the property out for $1,500, covering the mortgage and generating positive cash flow. BRRRR strategy: buy, rehab, rent, refinance, repeat. What is the BRRRR strategy? BRRRR stands for buy, rehab, rent, refinance, repeat. This strategy allows you to build a portfolio by recycling your capital through multiple properties. How BRRRR works: you buy a distressed property below market value, rehab it, rent it out, and then refinance it to pull out the equity. You use the cash from refinancing to buy another property and repeat the process. Why BRRRR is powerful: BRRRR allows you to build a real estate portfolio without tying up large amounts of capital. Each time you refinance, you extract cash to fund your next deal, creating a snowball effect. Real-life example: you buy a fixer-upper for $100,000, spend $30,000 on renovations, and rent it for $1,500 per month. After refinancing, you pull out $50,000 in equity and use it to buy another property. Over time, your portfolio grows with minimal upfront investment. Conclusion: investing in real estate with little to no money is entirely possible if you leverage creative financing strategies, partnerships, and other people's resources. Whether you choose to wholesale, house hack, or use BRRRR, the key is taking action and continuously learning. Start small, build your knowledge, and you'll be on your way to building a strong real estate portfolio with minimal upfront capital. If you found this video helpful and want more tips on investing, finance, and building wealth, don't forget to subscribe to Muscular Brain, Fat Wallet, and hit the notification bell so you never miss an update. Keep pushing toward financial freedom.